Okay, all right, let's get started. So welcome everyone to FFT's Autumn Budget 2024 webinar. I think it's been a very widely discussed and publicised budget, probably the most in recent memory. In today's webinar, we're not trying to cover absolutely everything. There's obviously a lot in the finer detail, and there's areas that probably don't impact our client base that much. So we're really going to try and cover the areas that we think do. Before we get into it, just a note that we're going to be doing a short Q&A at the end. So please, if anyone's got any, please enter any questions into the Q&A box. So really the next few slides are just about setting the scene and trying to give us the big picture of the point of all this and where we're kind of expecting to land once it's all been in place for a few years. So we've got the new government and a fresh approach to fiscal policy. In the first budget, Chancellor Reeves has made it clear her vision for the UK is an economy growing, creating wealth and opportunity for all. And the main strategy is invest, 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 which non-coincidentally echoes the famous education, education, education commitment of previous Labour governments. The context is that the UK faced slow economic growth, a £22 billion black hole in public finance, and the plan is to raise taxes of about £40 billion. It was well documented that the government's manifesto, it committed to not increasing income tax, VAT, or national insurance, i.e. taxes that impact individuals. And I think this was always going to cause a problem, given that those are the main sources of income. After the election, the government began using the term for employees when referring to national insurance. And lo and behold, as we all know now, probably the biggest hit in the budget relates to employers' national insurance. And that will actually raise £24 billion out of the £40 billion. And the idea is not to have any short-term fixes here. The budget philosophy was to emphasize long-term stability, focus on long-term growth, and reshaping the economic landscape. There was a commitment to balancing and stabilizing the economy, and that included long-term investment. So the Office for Budget Responsibility, the OBR, has given some growth projections off the back of the budget. And as you can see, that's 1.1% in 2024, 2% in 2025, and around 1.5% by 2027. In fact, the total economic growth is set to be 8.2% by 2028. I think it's interesting to see that in March earlier this year, before the budget, it was forecast to grow by 8.5%, so actually a slight decrease. I think many would agree that those numbers are quite disappointing, especially given the sacrifices that businesses are being asked to make throughout the budget. We've also been told, given the economy will be largely the same size in 5 years, that there may be further tax increases in future budgets. There is a bit of improvement forecast way in the future in 2032, but I would say who knows what the world economic and political landscape will look like at that point. The growth dictated by the budget was to end austerity, and there was a pledge by the government not to borrow for current spending, although they'll be borrowing for investment. And what that investment will look like, well, there's a plan over the next 5 years to invest £100 billion in infrastructure, housing, research and development, and also obviously additional funding for the NHS. Government's also established a £70 billion or aiming to attract £70 billion national wealth fund of private investment, and it will be supported with public funds, and the projects will obviously likely be of benefit to many projects. yeah, very much the strategies are forward-looking and laying the groundwork for sustainable economic growth over a longer period. But as I said in the previous slide, there is a bit of doubt over the long-term credentials. They're not that exciting at the moment. Very big talking point of the budget, capital gains tax. So, as many of you already know, capital gains tax is payable on the gains you make or a business makes on the disposal of assets such as shares or property. There was a lot of rumor before the budget about the changes that were going to come into place. And on budget day itself, the changes announced were that the lower rate of CGT would be going from 10% to 18%, and the higher rate from 20% to 24%. Now, those line up the main rate with those already in place for property gains, and the property gains rates have stayed the same. I think a bit of a reality here after the budget was that quite a few did breathe a sigh of relief, given that the changes are a little bit lower than some of the rumors. There were rumors that the rates would increase somewhere between 30 to somewhere between 33 and 39%. And I think, from our point of view anyway, the budget's kind of recognizing that the revenue gains from these changes are fairly small, and they're sort of trying to tread a bit of a middle ground, sort of saying, we'll tax the rich more, but not very much more. I think from our point of view as accountants working with businesses, we obviously consider it a bit of a step in the wrong direction for new business and for entrepreneurs. Another minor point to note is that the annual allowance, which is £3,000, is set to stay the same for the next few years. It's not going to increase, and that's a little bit of it's a stealth tax. Over time that does worsen the position if it's not going up. Another area that people are familiar with is business asset disposal relief, BADR, and that was formerly and more commonly known as entrepreneurs relief, and that's been impacted as well by the budget. So from April 25, the rate for BADR will rise to 14%, and in 2026 it'll align with the main CGT rate of 18%. There's also a less commonly known point around investors relief, where previously it had a 10 million lifetime allowance, and that's fallen to 1 million in line with the ADR. I wanted to show the impact with a little bit of an example, or one example of the impact of those rises. So on this slide, this is a situation where someone's selling shares in a business. They may have built it from scratch 20 years ago, and they own 100% of the share capital. And this is to kind of illustrate over the course of the changes, the change in the tax payable. There's an assumption here that the person still has their full lifetime allowance of 1 million for BADR. And as you can see, before the budget, with the 20% rate and the 10% BADR on the first £1 million, the total tax payable would have been £199,000, an effective rate of 13.3%. After April 2025, the first increases come in, and the rate goes up to 14.6% effectively, with 219,000 tax payable. And by 2026, we've got the full amounts, the full rate increases in place for BADR and for the main rate as well. And we end up with tax payable of just under £300,000. And that is an effective tax rate at 20%. It's actually a 50% increase in the tax payable. So, it's quite significant. I'm just going to go back to the previous slide just to finish off on capital gains tax. So I think an important point here when we're kind of looking at planning for the changes is that not all of them are coming in with an immediate effect. So there is an opportunity for some degree of planning. So what that might look like is, so one example would be, business owners that might be looking to sell in the coming few years, they might want to speed that up before some of the changes kick in to maximize the amount of money they receive after tax. I think obviously, real world, a business, if you don't have anything lined up, it's rarely swift to sell a business. It can take time to find a buyer. It can take time to agree all the terms. And, I suppose one other option out there that owners could consider is potentially if there's an opportunity for offering a management buyout to employees, because potentially they can be a bit more straightforward in terms of finding a buyer. And maybe people being on the same page. So there's one option there to speed things up. Another situation you could have is that where now we've already got a deal underway, there's already things being talked about, but we've got one of these increases closing in. Well, what we could do is potentially have an earlier exchange of contracts with a longer completion date, and that might lock in a lower rate. I think definitely with that example, you'd need to be making sure you're taking appropriate tax and legal advice. Some might think they're going to be clever, and they might consider trying to sort of beat the system and the upcoming increases and force the crystallization of capital gains tax. And that could be done by rebasing the market value of an asset. And that is done by doing things like selling and rebuying an asset, or maybe trying to sell an asset into a company. However, this is a bit of an old trick, and so you're aware HMRC have already thought about that, and there is anti-avoidance legislation in place, so I wouldn't go down that route. And really, one point around this is that people need to be reviewing their sort of tax efficient wrappers, ISAs and pension allowances and that sort of thing at this point to make sure they're taking advantage of them. Okay, so the next section is, another huge area in the budget, and that's around inheritance tax and pensions and that kind of thing. So again, with the inheritance tax changes, yes, there've been several big changes, but they're not immediate. So there is opportunity for planning. Pension pots. The government's going to start taxing all unspent pension pots from April 27. And really the idea, the philosophy here is that the point of a pension and the tax benefits that go with it is really there to provide financial security in retirement rather than passing wealth on to the next generation. And really some of the changes are probably a knock-on effect of the removal of the lifetime limits last year. So just to give an example of the potential impact of this change, and it can be a really high effective tax rate. So let's take £100 as an example of pension pot money. That now would be subject potentially to 40% inheritance tax, and that would leave you with £60. And then on death, the money could then, and I'm not sure that's completely confirmed, but it seems to be the generally what people are thinking. It could be subject to income tax for the beneficiaries, and that could be in the worst case another 45%. That would result in just £33 being received, which is an effective tax rate of 67%. So very significant. Naturally, obviously, this is all very frustrating for those who've done already generational wealth planning, and there'll be more planning to be done. We think the measure could particularly hit families afflicted by an unexpected death at an early age, when there'll be less of the pension pot available now. Planning's obviously going to be hard around this because planning could lead changes could lead to tax elsewhere. One suggestion we had is that somebody was considering a better option to draw the entire pension immediately now, suffer the income tax, and then try and avoid the inheritance tax in the usual way for the residual funds by things like gifts and trusts and that sort of thing. There could be a few people going down that route. One thing also that people may consider to try and reduce their pension pot and bring it over to the next generation would be, and it's not that well known, but gifting out of excess income. So the way this works is there's kind of three rules around that. So a gift has to be part of your normal expenditure, i.e. it has to be a regular gift maybe on a monthly basis. It has to be a gift out of after-tax income, taken one year after another. And also, you have to make sure that the amounts gifted leave you with appropriate level of income to maintain your usual standard of living. But there's definitely opportunity there. I think despite all of this, it's important to remember that there is still a very valuable aspect of pensions, being the gross tax-free roll-up of income and gains on investments, which obviously still has some value. Another area that's been well documented is business property relief and agricultural property relief. I think on the agricultural property relief, or APR, we're not going to spend too much time focused on that. We are very much a city centre based firm of accountants, and we don't act for many farmers. So, the changes are that where previously, with the right circumstances, there would have been 100% relief on passing these shares over to the next generation, we've now got a £1 million threshold, and beyond that, it's a 50% of the normal rate, so a 20% rate of tax payable. It's well worth being aware that because the relief's not transferable in the cases of married couples or civil partners, both should should consider both of them holding shares to maximize the available relief. So that basically means that each one would get a £1 million allowance, and then potentially you've got your regular allowance as well of up to £500,000 each, and there's potentially £3 million there of relief. So some smaller entities might be protected just based on that. Going forward, people, business owners, families, they're going to need to consider whether or not they're going to pass on the shares during their lifetime, and they'll need to be considering the sort of 7-year survival requirements to escape inheritance tax, and also, what practically that transfer means. A loss of value to the business, a loss of control, and again, professional advice is obviously important here. Another area of planning around this is going to be in relation to trusts and other corporate structures such as family investment companies. One question mark we have around trusts is, normally when there's assets in a trust, there'll be a 10-year charge at 6%. But we kind of feel that it might be fair that because there's a 50% reduction on agricultural property relief and business property relief, if those sort of shares are in the trust, maybe it would be fair to reduce the 6% to 3%. But that's pretty speculative, and we don't know what's going to happen there. It would seem logical and fair, but fair isn't always the way, which I think this budget has perhaps illustrated at times. Possible planning point on trusts, quite simply, because they can be broken up, is just to buy time, given they're sort of generally a long-term structure. So, wait 5 years, see what the budget changes are in those 5 years. Is there going to be a new government with completely different rules in 5 years? That is one possible way of planning, not doing anything at all. Something else that's now popular as a result of this budget is life insurance. So people are taking out policies, trying to design these to cover inheritance tax that might now be payable on estates that wasn't previously payable. But obviously there's practical way-ups here to be done on the cost of the insurance policies, etc. One thing one problem that's created by these changes is the actual funding of the tax payable. So in the case of the pensions, it's not such a difficult thing because they're going to be funded directly from the pension pot. So at least the funds will be there to pay the tax. But that's not the case for businesses or farms. There is, in many cases, HMRC allow you to pay tax over 10 years, and not in every case. But it's worth noting interest will be payable on the outstanding tax balance as you go along. And also, actually, if it's quite a large inheritance tax bill, let's say it's £1 million, if year one payable is £100,000, you still have to find the £100,000 after the first 6 months. So it's still a fairly chunky payment to find. And one quite sensible suggestion that we've had is that it would be fair if businesses could make the tax payment out of their reserves, a bit like what the situation of making them out of the pension pot, and that would be fair because it would avoid the double taxation of having to extract the funds and then pay the tax from those extracted taxed funds. Another point around inheritance tax is on the AIM market shares. So these have always been, or recently been, a popular form of inheritance tax planning because they qualified for business property relief under certain circumstances. But now, obviously, that you've got 20% IHT payable on death, and there isn't an allowance, a £1 million allowance for those assets. So it's certainly not going to be as an attractive option for investors as it has been. My final point on this is the fact that the bans have been frozen. So the nil rate bans for inheritance tax have been frozen to 2030. Again, that's a stealth tax. And as that's not increasing over time with inflation, the position's worsening. So another pressure added onto estate planning. I'm now going to pass over to Adam to continue with tax on employment.
Thank you, Sam. So now on to employment taxes. Rachel Reeves reaffirmed the commitment not to increase income tax, VAT, or national insurance for working people. I see the Prime Minister had a really hard time at PMQs today from Kemi Badenoch about that phrase, working people, and I think that's going to be an attack line over the next few months. However, as Sam said, the budget introduces significant changes for employers. From April 25, the rate of employer national insurance contributions is going to rise by 1.2% from 13.8 to 15, adding an estimated £25 billion to the public finances. Employers will also see the threshold at which NIC applies drop from £9,100 down to £5,000 per employee. So this measure of lowering the threshold in itself results in an extra £615 employers' NI cost per employee, without even considering the 1.2 rise in the rate on earnings above 9,100. So it's a considerable additional per employee cost. To help small businesses, the government have increased the employment allowance from £5,000 to £10,500 and also removed the £100,000 NIC threshold, meaning larger businesses who potentially didn't previously get the advantage of the employment allowance can now claim £10,500 against their employers' NI, offsetting some of the increased NI. However, overall, the additional costs to the employers can only truly be absorbed in most cases in one of the following ways: either shoulder the cost and accept lower profits or less spare cash for investment in the business, suppress employee wages or reduce headcount, or finally pass on the cost to the customers. Obviously, none of these options are ideal or welcome, but they may be a necessity to maintain a healthy cash flow. Coupled with the NI increase, we're going to see an increase in the national living wage from April 2025, and that's going to rise to £12.21 per hour, meaning a full-time employee working on national living wage will earn an extra approximately £1,400 a year. And for younger workers, the minimum wage will see a historic 16.3% increase to £10 an hour. The increased national living wage and minimum wage now means a full-time living wage job earns almost £24,000 a year. And obviously, whilst increased wages for low earners is of course important, especially as we're coming out of a period of high inflation and a cost of living crisis, one has to also think about the knock-on effect for general wages. Speaking to clients, they're concerned about employees who are earning above minimum wage, but turning around and saying, well, everyone below me has had a wage increase. So how about me? I'm on £25,000. I want a incremental increase as well. So that's only going to add further to employer costs and put pressures on margins, prices, or wages. And the reaction I've had from clients over the past 2 weeks is a number of them are now thinking twice about taking on new employees. They're going to be looking at their current staff and making sure everybody's really fully utilized before hiring. And in some cases, one or two clients have said that they are considering curtailing expansion plans over the next year or so due to these increased employment costs. Clearly, not the reaction a Labour government striving for economic growth would be hoping for. So as a summary on employment taxes, the changes in NI does yield a good tax take of the government estimating around £25 billion, and the change in the employment allowance will protect the very smallest employers. It's also worth noting that the previous government cut employees' national insurance by 4% just over a year ago, reducing it to 8%. So even if employers pass on some of the rate increase to their employees through lower than expected pay rises, it may well be that employees are bottom line better off than they were at this time just over a year ago. And just to add that possible planning opportunities around the increase in national employers' NI, whilst options for salary sacrifice have massively reduced over the years, there are favourable terms for pension contributions. So it may well be appropriate for employers to look at their current pension arrangements and to see whether a switch to salary sacrifice pension contributions, possibly saving employers' NI on the pension contribution, whether that saving is maintained by the employer or shared with the employee. However, most employers would be more than happy to either keep it themselves or share it with their employee rather than sharing it with the Chancellor. So that might be an area businesses want to look at. However, it's not as straightforward as that. Obviously, legal and HR advice should be taken, as there are a number of knock-on effects to employers and employees. I'm going to move on to taxation of overseas wealth, which saw a number of changes in the budget. So the budget from Rachel Reeves brought about fundamental changes to the way overseas wealth is taxed, starting with the headline, which was the abolition of the non-dom status from April 2025. Currently, if you're non-dom and choose not to pay tax in the UK on your overseas earnings, you would pay either £30,000 or £60,000, depending on how many years you've been in the UK over the last few years. But with the scrapping of the non-dom status, it's going to be replaced with a new residence-based tax regime. This allows temporary relief from UK tax on foreign income and gains for only 4 years. Rather a niche point, but a potential planning opportunity for UK domiciled individuals. As domicile becomes irrelevant for income tax purposes and replaced with this 10-year residence period, there's a possibility that UK expats could move back to the UK for 4 years, potentially without their foreign income being taxed, provided they hadn't been in the UK for any of the 10 years prior to that. Obviously, a number of complicated areas, and anyone who's in that position, or if you know anyone in that position, we would obviously advise taking specialist advice in this area and not to make any mistakes. There were changes on overseas IHT as well, meaning that IHT, inheritance tax, will now apply more broadly to offshore trusts, effectively ending this common tax shelter. The IHT change will effectively bring into UK inheritance tax non-UK property, something that people should be aware of. That is a change. Again, from conversations with clients, some clients have nightmares about leaving an IHT problem, whilst others are not concerned in the slightest. They just say it's not going to be their problem. So it's something people should be aware of, and it will matter to a varying extent to different people. For CGT, the remittance basis users can rebase foreign assets to their April 17 value for disposals, but there are strict conditions. And this budget also scraps the previous 50% reduction of foreign income in the very first year. And there's a repatriation facility, which is extended to 3 years with expanded allowance for offshore structures. This facility will be available for individuals who've previously claimed remittance basis, and they'll be able to designate and remit at a reduced rate foreign income and gains that arose prior to the changes. The facility is available for a limited period of 3 years, beginning in 25-26, and the rates being 12% in the first 2 years and 15% after that. Obviously, these are all specialist areas, and anyone who has anything which falls into these areas, we would ask them to reach out to make sure that they get appropriate advice. The budget did give some information around business taxes and offered some stability to businesses in the future. The corporation tax rate has been capped at 25% for the rest of this Parliament, which therefore should provide some reassurance for businesses planning their growth strategies. And many of the key reliefs, R&D tax relief, full expensing, AIA and patent box, these are all set to continue, which allows and gives support to businesses in their ongoing investment in innovation and infrastructure. First-year allowances for zero-emission cars and electric vehicle charge points have also been extended to 2026, which gives further incentives for businesses considering sustainable investment. This is an area we do like to keep an eye on, as a large number of our clients now have electric cars. But one can assume that as the tax take from diesel and petrol cars reduces over the next few years, electric cars will start to suffer larger tax rates in order to claw back some of this lost tax take. Something to be aware of for people taking out a 3 or 4 year lease or HP now. Indeed, we already know that from April 2025, electric vehicles will have to pay road tax, and there will be a supplement for expensive vehicles with a list price exceeding £40,000, which obviously, when it comes to the more expensive electric cars, can mean almost all of them. There was a notable change in the budget around SDLT, and for those in the property sector, landlords and investors, they're going to face higher costs if they intend to expand their portfolios. The additional dwelling stamp duty land tax, SDLT, is going to increase from 3% to 5%, and that increased immediately the day after the budget. Increased SDLT also applies for companies buying residential properties in England and Northern Ireland. This, coupled with a number of temporary measures amending thresholds and first-time buyer thresholds coming to an end at the end of March, means there's quite a number of changes that people who are active in property investment need to be aware of. And many are going to see their SDLT liability increasing going forward. This change may well impact landlords' planning, especially those who are aiming to grow their holdings, as higher SDLT may affect in your investment returns. It's also possible landlords will pass this additional cost on to tenants, resulting in increased rents or arrangement or processing fees. Together, all these measures around business tax stability, at least we have a plan for the next few years, and businesses do have a roadmap for planning, but there are clearly going to be rising costs in specific areas. The budget, just briefly touch on a couple of areas in the budget where HMRC announced some changes. There are going to be some changes at HMRC, so there's going to be an investment in some additional compliance staff and debt management staff, and one which has taken a number of people by surprise is the suddenly what's jumped upon us really is the now high rate of interest that HMRC charge on late payment. And in the budget, they said there would be an increase of 1.5%. So now your debts to HMRC are now suffering interest at over 7%. And that could be rising to almost 9%. And no longer can owing money to HMRC be seen as a cheap line of credit. Finally, for this section, just wanted to point out that the budget introduced anti-avoidance measures, whereby in some circumstances, a closed company making a loan to a participator, for example, a director's loan, even if the loan is repaid within 9 months, in some cases, Section 455 tax may be payable. It's specifically targeted at circumstances where companies have been looking to avoid the tax, the Section 455 tax at 33.75%, by e.g. repaying and then immediately advancing the same monies. This is not a new restriction. Many will be aware of this restriction, what we in the business call bed and breakfasting. However, it appears to be an area that's been highlighted for action, and this highlighting together with, as I said, more resources and inspectors at HMRC points to an area that HMRC may take more interest in going forward. There are a few other points in the budget, just wanted to touch on each one briefly. The income tax bans, as Sam mentioned earlier, income tax bans have been frozen for a good number of years The personal allowance was £12,500 in 1920, rising to 12,570 in 21-22, and it's stayed the same ever since, meaning that unknowingly, people quite often, as they've received a wage increase, they've moved through the tax band just through the natural wage increases. This has obviously helped the Exchequer with the tax take. However, the government expects that the thresholds to start rising again with inflation from April 2028, but they will have stayed at the same level for a good 6-7 years. Changes around child benefit. The high income child benefit charge is a tax charge applying to high earners who still get child benefit or whose partner receives it. In 25-26, so in next tax year, the income threshold for the high income child benefit will be £60,000, with the previous government had raised it from the lower rate of £50,000. And how this works is that the charge is charged at 1% of the child benefit payment for every additional £200 earned above the threshold, meaning that child benefit will not be fully withdrawn until the individual has a net income or adjusted net income of £80,000 or more. Again, this was a threshold the previous government raised a year ago from £60,000, or when they announced would be increased. The government also announced that they wouldn't proceed with the reform suggested by the Conservative government, which was to look at a household income basis rather than the individual income basis. This is, we would see as a shame, because it does maintain the perceived inequalities in the system. You could have two parents, each earning £59,000, being able to claim full child benefit, whilst a single working parent family earning £70,000 or £80,000 potentially missing out on the benefit. So a household income scheme, as proposed by the previous government, whilst undoubtedly due to our current personal tax system being hard to administer, it would have alleviated some of this inequality. However, I would say on this subject, with the increased limits around child benefit, it might be an area that people who previously didn't claim might want to look at whether they would now be eligible to claim and keep either in full or part. So it's worth looking at, or if you have any questions, to reach out to us on that. A running joke in the accountancy world, due to the amount of times governments have messed around with these rules, is around the double cab pickup. And the government will treat double cab pickup vehicles with a payload of 1 tonne or more as cars for certain tax purposes. So from 1st of April 2025 for corporation tax and 6th of April 2025 for income tax, these particular vehicles will be treated as cars for the purposes of capital allowances, benefits in kind, and some deductions from business profits. The existing capital allowance treatment will apply to those who purchase these vehicles before April 2025, and transitional benefit in kind arrangements will be in place for employers who've purchased, leased, or ordered a vehicle before 6th of April 25. They can use the previous treatment up until the date of their disposal or lease expiry, or April 2029. For those who were able to take advantage of the double cab pickup vehicles, the previous treatment as a van as opposed to a car, the change is obviously a disappointment, as the vehicle will now be taxed at the higher car tax rates. Something which was widely discussed and known about in advance of the budget was that private school fees for education and vocational training will no longer benefit from VAT exemptions and will be subject to VAT at the standard rate. The change will apply to terms beginning on or after January 2025, although in certain cases prepayments made after 29th of July 2024, which was shortly after the new government took office, will also be included. So there's some anti-avoidance there for people who potentially paid up front the minute that the Labour government came into power. Just say in this area, this coupled with changes to business rates relief means such private schools will have huge cost or cost increases and pressures come the new year, and it's almost definitely going to lead to increased fees in the private school sector. And, you know, most likely due to that, the flow of some children back into the state sector. So whether this policy has been for the financial gain of the government or purely a political policy is obviously up for much debate, especially when you factor into it the cost of taking extra pupils into the state sector, and what apparently was missed in the planning for this policy, the fact that now VAT registered schools will be able to claim VAT refunds on building work which has already taken place. That, you know, obviously weighs into this much charged political debate. And in fact, a number of schools have taken legal action against the government. So I would say watch this space, but as it stands, there are big changes afoot for private schools. And for 25-26, eligible retail, hospitality and leisure properties in England will now receive a 40% relief on their business rates liability. And they can receive support up to a cash cap of £110,000 per business. And the small multiplier, the multiplier for small businesses in England's frozen at 49.9p. So worth noting, the current relief is 75%. So many retail, hospitality and leisure businesses will be facing a big increase in their business rates come next year. And we've already seen in the past week a number of high profile businesses in this sector coming out and saying this is going to be a real struggle for a sector that really hasn't properly recovered from the effects of the pandemic. So again, watch this space, because there may well be a big impact on what we know on the high street. And finally, vaping duty has been introduced to discourage vaping, and tobacco duty has also been increased, we guess, to discourage the consumption of tobacco and push people towards vaping. Either way, whether you're consuming tobacco or you're vaping, it's going to be taxed. And in the budget's big giveaway, alcohol duty for draft products was reduced by 1.7%, but don't get too carried away. That meant an average pint at the pub reducing by 1 penny. So just to wrap this up, our final thoughts on the budget. This budget came to present and try and deal with some real significant challenges for the country, but seems to have placed some real significant challenges for small and medium-sized businesses. The increase in national insurance and minimum wage could really restrict job creation and add costs for businesses still struggling with the cost of living crisis. The changes to CGT and IHT are going to make it more difficult for business owners to generate and pass on their wealth. The vast majority of the tax to be raised from this budget came from the employers' NI changes, with the rest of the changes being real small change to the government. So the impact of this budget will really be felt by businesses and employers. However, the government focus on investment stability, market stability and corporate tax certainty could well yield long-term economic benefits. It's essential that businesses understand how these changes may impact their finances and seek out appropriate guidance to navigate this evolving landscape. The landscape may well change further in coming months as we hear more reaction from the business world and the markets, and as to what they really think about how the economy might grow. And as Sam said, therefore, I think we all need to be on the lookout for further announcements and whether there will be further government action in the coming months.
Okay, great. Thanks, Adam. Okay, so final part of this webinar, any questions? So we have had a couple come in through the Q&A, and if anyone's got anything else, please put them in now. But I think the first one I'm going to have a look at is, so someone's asking, can I get multiple employment allowances across multiple companies? So the employment allowance, as Adam said, has gone up from around 5,000 to around 10,000, so a decent increase there. And I think the answer, and it will be very nice to claim it 15 times and £150,000. The answer is no, you're not going to get that. You can split it across different companies, but only one amount across those companies. There's a rule, and it's a rule that's already in place, meaning that companies that are associated to each other, so there are various ways you can be associated, but to be simple, the same people are controlling them for these purposes. But across associated companies, it can only be claimed once. So yeah, sorry, not good news there. It is worth noting there's been that removal of the 100k limit, so there are quite a few people out there who couldn't claim it at all, and can now claim a full £10,000. Let's have a look. So yeah, another one is business asset disposal relief, or entrepreneurs relief, as it's been quite commonly known. Do the changes apply straight away? So I think I did probably cover this, but not to worry. So the capital gains tax increase, the main increase was from the morning of the budget itself, which was the lower rate going from 10 to 18%, and the higher rate from 20 to 24%. But for BADR, no, the rate will increase to 14% in April 25, and then a further increase to 18% in 2026. So as I said earlier, there is opportunity to kind of try and speed things up or plan a bit to try and lock in those lower rates. And I would also note that at 18%, it's still a fairly favourable rate compared to the income tax rates. Anything else? Just one more, I suppose. This one: will you be voting Labour at the next election? I think it's a tricky one to answer, because I'm not answering as Sambakul. For a start, I'm going to answer as FFT, and the answer as FFT is not very exciting, and it's that we're apolitical and can't comment on that. But we'd note that as accountants, lots of tax changes are good things, but they're, I suppose not so good in many cases for our clients. Yeah, so I think so that's that for now. If anyone does have any more questions, or if we haven't answered something now, or if I've missed something, then we'll have a look at those and try and answer after this. Or if anyone wants to get in touch, please do. And if there's any more information or assistance needed with the budget, or anyone wants to have a conversation, please get in contact. There's our mail at FFT email there, and our general phone line, but you can also just contact your normal contact at FFT, and if they can't help you, they will pass you to somebody who can. But that is it for today. So thank you very much for joining us. We hope it has been informative, maybe not entirely enjoyable, but hopefully useful. And we are looking forward to seeing you all soon.